Welcome back. Here with Money, Money, Money. And this week, we are in conversation with the top boss of BIRLA Sun Life Asset Management Company. We have Bala with us in our studios. So, Bala, now we're going to get down to the specifics, the questions that I always ask you. I mean, and we're taking the prototype of a person with a medium risk appetite, someone who's in their mid-30s to early 40s, is looking at creating wealth via mutual funds. So now, looking at the current market environment, let's get the asset class mix first out of the way. Would you advise more exposure to debt, given the fact that the equity market has run up, or how should it be?
See, I think your question itself answers some of those questions, which is around the age is 30, and he's looking at not 5 years or 10 years. He's going to look at 25 years, maybe till the age of retirement. If you take, he has 30-year time period actually for him to look at investing. And therefore, a large proportion of the money should always be considered for equity. Okay. And if you go with a simple fundamental thumb rule, which is 100 minus your age should be your equity allocation. Which I think is a widely believed thumb rule that followed actually globally.
While that thumb rule holds, I totally get that. I mean, what would your advice be to a lot of the slightly older investors? Because of late what's happened is that we've got so many viewers on Money, 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 people who are senior citizens who want better returns from their money and they're not comfortable only debt.
Correct.
So therefore, they're trying to move to equity. What would you advise them looking at the market?
So there's one asset class which exists, which is called hybrid asset class. Hybrid asset class varying from high exposure to equity, which gives you actually some bit of equity flavor, which is called balance fund. And balance fund as a category, it invests about 70% in equity and 30% is debt.
Yes.
And most of the time, people do have a questions mark in mind that should I take exposure to cash because the equity market is high and so on and so forth. That gets automatically adjusted in the balance fund. So that's something which is the aggressive investors, but relatively conservative when it comes to the question of equity exposure. Therefore, they should look at the balance. One is the hybrid category. So the other hybrid category, which I think from a fixed income senior citizens point of view, there's another hybrid category which exists, which comes in the conservative category of the hybrid category, which is has got 20% exposure to equity or 20% exposure to equity, and balance is invested in debt. And such kind of investment can also be considered by a senior citizen. Conservative hybrid funds such as monthly income schemes could also be considered. Okay. And my experience in the last many years, number of if you take, in my own career, I have seen booms and bursts in the stock market repeatedly every 3 years I used to see. Now I think we are a lot better. And so in that period also, the monthly income schemes of having exposure to about 20% equity have done relatively better.
Okay.
Even compared to the fixed income schemes. So therefore, the time horizon he has to keep in mind. And second is, what is his purpose? His purpose is actually to get some bit of regular income at the same time, get a little better return
than just a fixed deposit, which
hybrid
is
schemes. Hybrid schemes are the best asset class that one should look at.
So now I'm going to get down to some of the fund choices, and what I did was I asked Bala to come up with a list of funds from the BIRLA Sun Life universe, which he likes, which he thinks will make sense for an investor at this juncture. And I'll start with the hybrid funds first because we're just discussing that. Bala, you picked the BIRLA Sun Life Balanced Advantage Fund, and also the Balance 95 fund, I believe. First, tell us the difference between these two.
See, Balance 95 is a static equity portfolio, which invests about 65 to 70% in equity, and Balance is invested in 30-35% in debt. So, this asset allocation, which is the equity and debt allocations, is more static. If the market goes up and the equity assets goes up, then you bring it back to 70%, and that's the way the portfolio is done. And whereas in the case of Balance Advantage Fund, it's actually depending upon the market, volatility, depending upon the perceived assessment on the valuation, which is the price to book multiples and PE multiples. You apply some principles to reduce your equity exposures and increase the equity exposure. That is a dynamic allocation that moves in equity.
So Balance
Advantage Fund, where you allocate your equity exposure on the base of your view, which is driven by certain benchmark that we keep, that parameter that we need to track, on the base of which you increase the exposure to equity or reduce the exposure to equity. Sometimes it could be 40, exposure 40% exposure to equity, that's the minimum we expect. It can go up to 70.
So in a market situation like this, I haven't checked the latest levels. The Balanced Advantage Fund, typically what's the debt equity mix it will have right now when the equity market is at an all-time high?
See, today I think on the base of the principle that we apply, the price to book principles and PE multiples, the equity exposure in the Balance Advantage Fund is close to about 45%.
Okay.
Which again reflects, as I mentioned earlier, The fund manager view on the basis of the model. We put some kind of discipline and within the boundary we have to operate. Whenever you put in a boundary in which you have to operate, then you need to also respect the boundary. And then operate as a true manager you have to operate. You have to be true to yourself when it comes to the question of you have to follow some disciplined way of investing. On the basis of that, I think 45% roughly is the exposure to equity.
As opposed to the balance 95, where the allocation is more or less fixed.
Is about 65 to 70% is in equity.
Yes.
We move in that range.
Yeah. Okay. And now let's also just get clarity on the kind of stocks that a hybrid fund like this would invest in. Would it be primarily large caps? Because as an investor, I want to know that if I'm going into a hybrid fund which has 40, if not more, in equity, then what kind of stocks am I going in?
See, hybrid funds in general, given the fact that it has got large proportion of the money is invested in debt, and that takes care of actually the one underlying protection for the portfolio in the form of interest accrual and other thing coming in, the equity portion of the portfolio can be a bit aggressive.
So it can be more mid-cap.
It can be more mid-cap. It can be more multi-cap. Need not be necessarily has to track Sensex or Nifty or invest only large-cap companies. And that's the only way it can actually look at generating a little better return on alpha. And second, I think we apply the principle. In a large-cap focused fund such as fund equity, we do apply the principle of certain discipline of linking to the how much you can go underweight and overweight with respect to the BSE 200. That discipline we have been maintaining for many number of years. Whereas in the case of hybrid funds, we don't need to apply the same principle. We can actually apply a bottom-up stock picking principle on the basis of which you own the stocks in the portfolio.
Okay. So, I mean, I just looked at some of the past returns, not to say that past returns are a measure of future performance, but the balance 95, last 1 year has been pretty good, about 19%, and the balanced advantage actually 24% in the last 1 year. But for an investor, what's a realistic assumption he or she should have from these hybrid funds? See, or expectation, not assumption, the expectation that one should have from these funds.
See, expectation, I'll put it in two different angles. One, as far as the equity is concerned, the expectation should be always nominal GDP plus 4 to 5% as an equity premium that we should get. So nominal GDP is about 11, and then equity premium of about 4 to 5% if you take, and that should be the expectation one should set.
15% for a pure equity fund.
For pure equity fund. And the hybrid fund, actually, we should expect about 2 to 3% lower than that. In the pure debt fund, cannot generate again very high return, and over longer term, you should always count if your repo rate, bank repo rate is say it's X, and your 1 year fixed deposit of a bank is say Y, then your debt fund can generate at best about 1 to 1.5% more than the bank 1 year benchmark rate. And that should be the thumb rule that one should apply. And these are again indicative, not necessarily should be taken as a guaranteed. Though we always say the past performance actually is not the guarantee for the future performance. But if we apply a principle of this kind and then stay patiently for a period for which you are coming, then you will more or less get to that number what I'm saying.
Okay, so fair enough. Now we have the rules as well, so don't get too greedy. Bala has explained the sort of expectations, realistic expectations you can have from your mutual funds. We'll take a break, and on the other side, we'll talk about Bala's favorite equity funds. So stay right there.